Global trade tensions and a potential value-added tax hike in South Africa could derail 2 years of slowing inflation. That's according to Reserve Bank Governor Lesetja Kganyago, who was speaking on the sidelines of a meeting of G20 finance officials in Cape Town. Kganyago says uncertain trade conditions and retaliatory tariffs could impact South Africa by tightening global financing conditions, while he described the proposal to raise VAT as a self-inflicted shock, but added that should that move be made, the SARB would have to respond to the second-round effects on inflation. Government is weighing up a wealth tax. That's according to a Business Day report, which cites unnamed sources. The proposal emerged at a special cabinet meeting which focused exclusively on the possible amendment of the budget. The introduction of the wealth tax has the potential to plug gaping holes in Treasury spending plans, but could face fierce opposition as the move could drive wealthy individuals to relocate to more tax-friendly countries, and this would shrink South Africa's tax base. The G20 should establish a commission on the cost of capital, which is hindering the growth of African businesses. That's according to Trade, Industry and Competition Minister Park Stau, who was addressing a panel at the B20 conference. He's also commented that the challenges faced by the multilateral trading system and the World Trade Organization also had to be addressed by the G20 in terms of multilateral decision-making, governance and the dysfunctionality of the dispute resolution system. Commercial real estate transaction activities picking up. That's according to Redefine, which owns 59 retail properties in South Africa. It also has assets in Poland. The insights come as part of a pre-close update for the half year to end February. The Real Estate Investment Trust has maintained its guidance range of between 50 and 53 cents distributable income per share for the 2025 financial year. Redefine will release its interim results on May the 12th. African Rainbow Minerals has flagged a lower half-year profit. The diversified miner says its headline earnings could slump by up to 55%. ARMS pointed to lower average realized US dollar iron ore prices, along with a decline in iron ore and manganese ore sales volumes. It's also cited higher cash costs and a stronger rand-dollar exchange rate. Grindrod has warned shareholders of a profit decline. The Freight and Logistics Group expects headline earnings per share from core operations to slide between 25 and 28%. That's as it experienced lower volumes during the year, and it took a hit of as much as 200 million rand as a result of border disruptions due to unrest in Mozambique. The firm's results are due out on the 6th of March. Curro says it recorded a credible operating performance with strong cash flows during its 2024 financial year. And so its balance sheet is in a healthy position. That's as the private education provider expects headline earnings to rise by as much as 17.5%. This is despite a constrained consumer environment, which is reflected in a slight dip in the company's learner numbers. The firm will open its books on the 5th of March. Putprop is expecting a bump in half-year profit. The property investment company has forecast a rise in headline earnings per share of between 16.7 and 36.7%. The firm has not given a reason for the increase, but further detail will be available when the company opens its books on the 10th of March. And the composite leading business cycle indicator fell 1.8% month-on-month in December. That's from an upwardly revised 0.7% rise the previous month. The downturn was driven by decreases in 5 of the 7 components. The largest negative contributors were a slowdown in the 6-month smooth growth rate of new passenger vehicle sales and a decline in the number of residential building plans approved. In international news, Unilever Finance Chief Fernando Fernandez will be appointed as the next CEO. Heiner Schumacher, who is currently the CEO, will step down after less than 2 years on the job as the consumer goods group strives to revive its performance. Here's more detail in this report.
Unilever's chief executive Heinz Schumacher will step down after less than 2 years in the job. The Ben & Jerry's and Dove soap owner made the surprise announcement Tuesday. His departure comes just weeks after the firm announced underwhelming full-year earnings. Schumacher had reset the group's strategy to address years of underperformance. He also laid out cost cuts last year, including separating its ice cream division and cutting thousands of jobs. The consumer goods giant faces pressure from investors to revive its fortunes. Unilever chairman Ian Meakins said the board was pleased with the company's performance last year, but has much further to go to deliver best-in-class results. Schumacher is due to be replaced by finance chief Fernando Fernandez. Meakins said the board was impressed by Fernandez's decisive and results-oriented approach. Unilever, which also owns Magnum and Hellmann's Mayonnaise, made no change to this year's outlook, and the board said it was committed to further accelerating Schumacher's growth plan. Schumacher will step down in March and leave the company on May 31st. Unilever said he is leaving by mutual agreement. The CEO's surprise departure hit Unilever's shares, which fell 2% on Tuesday. They had gained more than 9% since Schumacher took over.
And industry data showed that overall sales in France, Italy, Germany and Britain were all down from last year. This is due to fully electric and hybrid electric car registrations in main markets not being enough to compensate for falling petrol and diesel sales. Let's take a look.
New car sales in Europe were down by over 2% in January. A jump in fully electric and hybrid electric car registrations in main markets was not enough to compensate for falling petrol and diesel sales. Industry data showed on Tuesday that overall sales in France, Italy, Germany and Britain were all down from last year. Only Spain recorded year-on-year increase among top-selling nations. The EU executive will present auto sector plans at the beginning of March, following talks with automakers, unions and interest groups. Car makers are struggling to compete with Chinese rivals and are bracing for US tariffs. They've urged the Commission to grant relief from potential fines resulting from CO2 car emission targets that came into effect in January. Some automakers have increased the prices of petrol engine models to encourage EV adoption, but the industry fears customers will simply buy fewer cars. January sales in the EU, Britain and the European Free Trade Area fell slightly below 1 million cars sold, the lowest volume since August. Registrations at Volkswagen and Renault grew by 5.3% and 5.4% respectively, while they fell by 16% at Stellantis. In the EU, sales fell by 2.6%, even as the registrations of battery electric and hybrid electric cars grew by 34 and 18.4% respectively. US President Donald Trump has raised tariffs on aluminium and steel and threatened a 25% tariff on imports from Mexico and Canada, as well as on all autos and semiconductors.